Hello, James Blacklaw's JB Commercial Finance here. As many of you know, I'm currently putting the finishing touches to a book to be released in the next month or so about business borrowing. Now, it's something I've been cracking on about for quite a while now, how businesses, small businesses, especially the SME marketplace, find it difficult to access finance. Obviously, banks have had their issues over the last decade or so, we know all about that, but I've been staggered as I've done the rounds to find out that the lack of information available to small businesses and the lack of understanding even about basic borrowing requirements. I've come across what I consider relatively sophisticated businesses turning over a decent amount of money employing people who still don't understand how working capital works, how the amount of debt they've got outstanding can influence their cash flow, and where to go to actually get specialist advice to help with funding solutions. So I'm really hoping that this book, when it comes out, answers a lot of those questions, and it makes self-employed people and small businesses a lot more confident when approaching, whether it's someone like myself, whether it's approaching a bank, or whether it's approaching an investor, with regard to getting the finance that they require. Makes them more confident in applying for it, knowing what to say, what to do, and the sort of things that a lender will actually be looking for when looking at an application. So I'm going to do a few brief explainer videos about things that come up in the book, which are really simple, really fundamental, but I think they're quite important to actually complement what happens in the book. And the first thing I want to touch on today is something very simple. It's the fundamental of all commercial property lending, and it's called loan to value. Okay, so loan to value. What does that mean? Well, it is an industry term, but effectively what it means is the amount of loan outstanding against the value of the asset. So, to give a crude example, if you had a property worth £100,000 and had a loan against it for £70,000, then your loan to value is simply 70%. Please excuse the pen, it appears to be running out. So why is this important? Well, this is important because every bank will have their own individual limit that they can lend against certain types of property, and that will be based on their loan to value. So I picked 70% here for a reason. As you can tell, I've got a new pen now. 70% is a very standard loan to value historically when it comes to commercial property. That way the bank is secure, they've got a buffer of 30% in there. It also requires you as the client to put down a 30% deposit. But it's important to note that in some industries this can vary. So for instance, the public house trade, quite high risk in recent years. Most lenders, especially the banks, will only go to 60% of a loan to value there. Now what that means is that as a client you're expecting to put down a deposit of 40%, which is quite substantial. Something which always surprises me is that businesses don't understand how much they have to put down for a property on commercial world. When you go and buy a residential property, whether it's a buy-to-let or more specifically your own residential property, the deposit you're required to put down can be quite small. Normally mortgage products can start from 3-5% of a deposit. So if you're looking to buy a property for £100,000, you're only expected to put down a deposit of anywhere between £3,000 and £5,000. That's quite low, certainly compared to the commercial world, where you would be looking at 30%, which is £30,000, which can have an impact on the day-to-day running of the business. So it's important to understand that. So this is loan to value. This is how it works. Effectively, it is how much a property is valued against the ongoing loan balance. And the banks would expect a margin of safety to be there to consider lending to the business. I'm James Blacklaw. I'm going to do a few of these very basic introductory videos. I hope you enjoy them and find them useful. Thank you.